All right, so in this video, I'm going to talk a little bit about some yield curve implications, just briefly. So banks are typically going to get hurt with an inverted yield curve. So let's talk about why that would be. So to understand that, you have to kind of go back to what the business model of a bank really is. So the basic idea behind a typical bank is that the bank is going to accept deposits from depositors, and they are then going to lend that money out to borrowers. And so if I am a bank and I am accepting deposits from depositors, I lend it out to borrowers. Basically, what my goal is as the bank is essentially to charge the borrowers one rate, then pay the depositors something less than that. And the gap is basically what I can use to fund my operations as a bank, compensate me for the risk I'm undertaking by doing this, and so on. Now, if you think about that, generally what that would mean is that if I'm a bank, I'm probably going to be paying something closer to that short-term rate to the depositors, but I'm lending it out perhaps to somebody to buy a house, so a mortgage, or maybe a 30-year rate. So I'm going to lend it out at that higher rate. I'm going to pay my depositor at that short-term rate, and that gap in between is basically where we're going to make money if we're the bank. And again, we have to compensate for risk and pay for all the employees and all the costs associated with running this thing. But that's the idea. So back to yield curves. Why do we care about that? Well, if the yield curve inverts, then what happens is those short-term rates have risen to be above the long-term rates. So here's what that would tend to mean. That would tend to mean that as the short-term rates are going higher, the banks are having to pay the depositors more, 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 more. And if the banks have to pay the depositors more, 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 and they loan the money out to borrowers at, in many cases, fixed rates for longer periods, the money that the bank is receiving every year from those borrowers isn't really changing, but the money that is being paid out to the depositors is getting higher and higher and higher because of the higher short-term rates, which basically starts shrinking the amount that's left over for the bank. And if the interest rates get high enough, it could even possibly go negative, where conceivably the bank would wind up paying more to depositors than they are actually receiving on the loans that they have in their loan portfolio. In which case, that's really not good if you're the bank. So from that standpoint, if I have an inverted yield curve, this tends to really depress the earnings for the bank because it's much harder for the bank to make money in that situation. And if the earnings go way down, that tends to cause the stock price to drop quite a bit. Okay. Now, on the other hand, if we have a situation where the yield curve reverts to being steeply normal, so the short-term rates get dropped a whole bunch, then what tends to happen is the banks have those existing loan portfolios with those longer-term rates. The lower short-term rates eventually start improving the gap there, and the bank can actually make a bit more money, and that can help to save them from becoming insolvent and things of that nature. So a normal yield curve tends to be easier for a bank to actually make a profit. When the yield curve inverts, that's a much more difficult situation. Now, something is worth noting that does change things. Obviously, the loan portfolio is not fixed, right? And banks sometimes are sluggish to increase with the rates they're paying to depositors, even though the Fed funds rate may be going up. So sometimes, banks are a little slower to raise those, partially because of these pressures. Now, along this line, if you kind of think about sort of how these rates are changing things for banks and financial institutions like that, let's kind of talk about how that plays out for like utility stocks, for instance. So in a prior video, I kind of talked about how utility stocks sort of look a little bit bond-like in the sense that they're pretty regulated, they've got somewhat more consistent cash flows, and as a result, they tend to behave a little bit more bond-like in that sense. So to the extent that that's the case, rising rates would tend to make bond prices go down. I would expect some level of that to probably occur for utility stocks as well. So utility stocks are probably going to be a little bit more bond-like in some respects than perhaps a lot of other stocks would be. And they're going to be affected a fair amount by what's going on with interest rates because those cash flows are probably a little bit more stable, a little bit more predictable, probably not as much growth. And so if it's a little bit more bond-like, those changes in the interest rates are bigger factors as it relates to the value of the utility stock. And one way to think about that is as the interest rate goes up, the discount rate's going up. And if the discount rate goes up, the present value of the future cash flows goes down. The value would be expected to go down. But that would also mean the reverse would also be true. So generally I'd expect that utility stocks probably would behave in a little bit more of a bond-like manner than perhaps a lot of other stocks would when rates go down, because those stable cash flows with the lower rates, the present values of those future cash flows go up, and that would tend to look a little bit more attractive. All right, hopefully this little discussion about yield curve implications has been helpful. Thank you so much for watching. Have a great day.